In this video, we're going to look at ARC Document Solutions. This company provides on-site printing services, archiving, and lots of other things, and it also sells products. It's considered a penny stock because it's below $5, but it looks like it has a lot of room to grow. And what I do in my videos is I run my discounted cash flow model to figure out the real value of the stock and also look at the financial ratios of the company and compare them to similar companies. I do this with you throughout the entire video, so it's like we're doing the whole thing together. Let's get started with the model. This company has a market cap of $34 million. And let's see what they're trading at. They're only trading at 78 cents. So one share is only 78 cents. And back in 2006, the stock was up to $35 a share. Let's get their free cash flow, because that's how you value a company. You have to estimate the future free cash flows and then discount that number back to today. And they have positive free cash flow, which is really good. A lot of the penny stocks don't have positive free cash flow. They're still operating in a negative. Let's get their net income. That's a profit and loss according to the income statement. And let's pull the revenue. These are the sales each year, and that's also on the income statement. So you can see 2 years they had negative net income, yet they have positive free cash flow. It does make it more tricky to value a company that has negatives in the numbers. Let's look at the capital structure of the company to get more information. They pay $5.2 million of interest on their debt. And let's see how much debt they have. We'll go to the balance sheet. We'll go to liability section. $17 million of current debt. That's debt due within 12 months. Long-term debt of $89 million. That's debt due after 12 months. Since interest payments are tax deductible, let's get their effective tax rate. And the income before tax, let's use the 2018 number. That looks like it's a better fit. $12 million of income before tax and $3.3 million of taxes. So they pay 28% in taxes. The cost of debt is 3.5%. Let's get the cost of equity. We need the beta. The beta is how much the stock moves relative to the entire market. And their beta is 1.63. So the stock moves roughly 1.5 times the market. Let's get some more information. Let's get their current assets. These are mainly cash, accounts receivables, and inventory. And we need current assets because we're going to look at the current ratio later, and that's part of the formula. That's $106 million. Let's get their current liabilities. These are debts and payables that are due within 12 months. That's also part of the current ratio formula. And the equity, that's assets minus liabilities. And we need this for a couple of formulas later. We also need their operating income, or EBIT, earnings before interest and taxes. That's $15 million. Let's look at a capital structure. Their cost of debt is 3.5%, and they have 43% debt. The cost of equity is almost 15%, and they have 57% equity in a capital structure. So the WACC is 10%, and that's a combination of the cost of debt and cost of equity. That's the rate we're going to use to discount the future cash flows. So we estimated 4 years of future free cash flows, and we also did a terminal value, which is all years past year 4, and we estimated these numbers based off of the previous financial information. We discounted those numbers back to today using the weighted average cost of capital, and we get a value of the company of $454 million. We divide that by 44 million shares, and we get an intrinsic stock price of $10.41. It's trading at 78 cents, so it's trading at a 93% discount, so it's a buy according to the model. Let's see what Simply Wall Street values the company at. They're valuing them at $6.20, so they're saying it's 87% undervalued to companies. 5 years ago, they were trading about $7, so the stock has been dropping ever since, and it's at a pretty low point, although they're still providing positive free cash flow, so I'm surprised it's this low. Let's look at the financial ratios to see if we get more information. And they have a good PE of 11.3, that's price to stock over earnings per share. I like to see under 15 for a stock. Price to sales ratio, really good, 0.1. That's price to stock over sales per share. Their price to book is 0.2. That's price to stock over book value per share. And they say if you have a price to book value ratio under 1, it's a steal. It's such a good value. Let's unpack the price to book value ratio, and I'll show you what I mean. So the numerator, the top of the equation, price means price of stock. That's 78 cents. And to get to the denominator, the bottom of the equation, which is book value per share, that's assets minus liabilities equals book value. See, 363 million for assets. And this is the 10K. So we don't have to go back to Yahoo. 363 in assets. That's in liabilities is 213,117, which is right here, 213,117. And then book value is 150, which is right here, total equity, 150. So the book value is assets minus liabilities, or equity. And now to get the book value per share, you just need to take the book value divided by the shares outstanding. And we have 43.5 million shares outstanding. So the book value per share is $3.44 because it's 150 million divided by 44 million, 344. So to get the price of a book value formula, it's 78 cents divided by the 344. So the formula is 0.23. So if the price to book value ratio is below 1, that means the balance sheet is worth more than the market cap. Remember the market cap? $34 million. That's the value of the company according to the stock market. So in theory, the company would be better off liquidating the assets. Then it would have $363 million in cash, paying off all the liabilities, which are $213 million. It will be left with $150 million. Share all that money with the stockholders. There was 43 million stockholders, so each one would get $3.44. Your 78-cent share now is worth $3.44. You just made a 341% return on investment. That's a pretty good return. So why doesn't the company do that? Just liquidate the business and pay all the shareholders off. Everybody would more than triple their money. Well, there's a few reasons they wouldn't do that. First of all, they're running a business and they want to grow the business and provide even more return to the shareholders. Second of all, they probably couldn't actually get $150 million. Even though the assets say it's worth $363 million, it couldn't actually get that money. For instance, goodwill is just the premium the company paid for when it acquired another company in the past. So it's not actual money. It couldn't get that $121 million. It's an intangible asset. The only asset which is guaranteed is cash. That's the only asset that we know the company can turn into cash because it's already cash. The other assets, they probably won't get nearly as much as what the balance sheet says. Let's look at the current ratio. That's current assets over current liabilities, and they could cover their current liabilities, so that's good. Really low ROE of 2%, so they're not providing much of a return to their equity holders. Interest coverage ratio of 2.8, so they can cover their interest payments almost 3 times, so that's not too bad. And 43% debt. The best way to look at ratios is to compare them with similar companies. I did a video on Illumina, which is in the same industry as ARC. And ARC has a better PE, price of sales, and price to book. But Illumina wins in every other category. And they're much, much bigger of a company, 54 billion market cap compared to 34 million by ARC. So it looks like ARC has a lot of upside potential, but who knows when it's going to really pop. That's the hard part to really predict. So let me know what you think of the video. Thanks for watching.